You are listening to Keystone Stock Talk Show, episode 310. It's great to chat with you again. This week, I kick off the festivities with a look at rare earth company Neo Performance Materials Inc., symbol NEO on the TSX, which has seen a sharp price jump 100% year to date. I will let you know if the rise is sustainable. Brennan, as always, has his heart set on reviewing some absolute garbage stocks, or maybe put better, waste management companies, specifically looking at Waste Connections, GFL, and Secure Waste Infrastructure, comparing the businesses from a fundamental perspective. Last and certainly not least, Brett takes a look at embattled small cap Dye Durham, symbol DND on the TSX, a provider of practice management software, data solutions, and payment technologies to law firms and businesses. The stock is down about 18% over the past week, far more than that year to date. The announcement of a delayed filing has felled the stock. Brett lets you know why this business with over 60,000 clients has quite frankly been such a crap show since it went public a number of years ago. All right, let's get to the show. I welcome my co-host, the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Doing good.
Yes.
I'm back from the big smoke. That's what they call it. Yeah, Toronto. That city is. I had fun. I had a good time at the Money Show. Talked to a number of clients out there, some potential new clients. Gave a couple talks. Had a good dinner with the organizers, some other speakers there. But I'll tell you, the entire city is blue right now because of the Blue Jays. Every time. I had the speeches, I'd come out and the stadium is right next door, and there was a game either going on or starting or coming out, and the city was just absolutely jammed. Everybody wearing Blue Jays colors. So it was pretty cool to see that. I am a Blue Jays fan. It's the only thing about Toronto I'm a fan of. I'm kidding. It's a good city, but no, a hockey fan. I'm Canucks fan. Well, love, hate. But it's like you can't like the Leafs, right? If you're anywhere else in Canada, and then but the Blue Jays, we only have one team in Major League Baseball in Canada, so kind of everybody piles on board. It becomes Canada's team, so it's something we can all get behind. Primarily Brennan.
And you didn't go to a game. I can't believe it.
I know I should have. Well, both of them actually got out after. I could have the last day, but honestly, it's 3 days there, and I was like, I'm tired in my room, and I'm just gonna watch this.
I know you were saying it's hard to get an Uber to or a Lift.
Oh, getting down. I actually stayed outside of town, so like getting downtown is fairly hideous in Vancouver or Toronto. Well, Vancouver too. Yeah. Big cities in Canada. And Toronto's the biggest, right? So yeah.
Yes.
Anything further? We want to get to the poll question. Mr. Donald had some information that could, or put out a tweet on Truth Social that could potentially impact the financial industry, the way we look at stocks. So we're going to kind of talk about that. Or do you want to talk about the poll question first and get into the news?
We can do the poll question nice and quick.
Okay.
And then we'll get into Mr. Donald Trump.
Mm-hmm.
So the poll question is just a nice simple one. Where do you think the S&P 500 will be in the next 12 months? 54% of viewers said higher, 28% lower, and 18% said about the same. And it's actually quite a bit of contrast between our poll from the prior week, which is with the economic scenario, where it was just dominantly we're seeing a weakened economic scenario or perceived economic scenario being weaker. And now on the stock market side, people are still expecting the S&P 500 to go up. So you just have that really disconnect between economics and the stock market, which does normally happen, but people will a lot of times conflate the two. But you do actually see the divergence here.
Yeah, it is always interesting to see. You see Main Street nervous, Wall Street, yay. Yeah, so there is a total disconnect there.
Yeah. I voted about the same. And, I just think that, consumers are hurting with higher prices. It's going to be interesting to see as well, just in the US, how much of an impact actually the reduction in tourism is, impacting the economy as well. Like I was watching some videos, just looking at, how much Canadian traffic is down in Vegas, for example. and whatnot. So, I voted about the same. I think the valuations are relatively high, and there might be some pressure economically. Of course, who knows? Who knows? In Canada, we just recently lowered interest rates, 25 basis points. Is that correct? I believe.
Yeah.
So that could potentially, I know that's Canadian, but that could, potentially, fuel the market a little bit. And like we'll also be waiting for a U.S. rate decision.
They actually just right before our recording, they
right before
cut by a quarter point. Yeah.
Oh, okay, as well, a quarter point.
Yeah.
Okay.
Both were largely expected.
Yes, correct. But yeah.
All right. So yeah, that is the first cut I will add for the U.S. this year. So you have to go back to last December. And so speaking of Donald Trump, this is something he wanted. We can go right into another thing that he wants, and that is the removal of quarterly earning reports, which would be a bit of a negative for us, to say the least. We enjoy our quarterly reports. We don't want to just rely on annual reports. Sometimes when we look at either OTC or foreign listed companies, they only report annually. And it actually does make our job worse because we're more reliant on external information. We don't have the same depth of the company financials and just the general commentary too. They don't, quarterly reports normally you'll be coming with updated conference call, presentation, and then just a general news release as well. So just that routine nature does force companies to push out additional information, which is always great for us. But if Trump gets his way here, we're going annual.
Yeah, for sure. I'll give you my thoughts on this. There's generally the pros here. The more frequent company reports, the better investors can price in risk and feel more confident about equity markets. A little more complicated than that, but the cons would be the dollar and time cost to putting out these reports can be onerous for smaller companies. This is traditionally the two sides of the argument. Investors like Warren Buffett have long called for kind of longer term focus from management. However, Buffett, he has not called for less disclosure. Jamie Dimon and himself co-wrote an op-ed piece in the Wall Street Journal. I think it was back in 2018. They argued that quarterly financials drove short-term thinking at public companies to the detriment of shareholders. I'll quote part of their article. It said, companies frequently hold back on technology spending, hiring, and research and development to meet quarterly earnings forecasts that may be affected by factors outside the company's control, such as commodity price fluctuations, stock market fluctuations, or volatility, and even the weather, they wrote. That was the funny part at the end. So, well, I mean, actually, it was a commodity business. It could be affected by the weather. Insurance, it can be affected by the weather. But neither Diamond or Buffett were against quarterly or annual reports. They wrote in the op-ed piece, but said the information disclosed and the frequency of the reporting should suit the needs of the company and its investors. We are, and I am in the business daily and have been in it for well over 2 decades. Good management teams and good businesses still focus on the long term. Quarterly disclosures does not prevent this. Short-term investors may not like near-term growth spend, for example, that temporarily depresses earnings. They can sell, but it's an opportunity for long-term investors. As an example, when disclosed in a timely manner, can be easily factored into investment models. Who is often focused on the short term, I would say, is bad management teams, often in bad businesses, regardless of the disclosure rules. If you decrease disclosure, get ready for far more volatility on earnings day and far more potential for fraud. And that would be my major worry. If your goal is to reduce cost, look at some of the legal and accounting fees that have become exorbitant in some cases and are often cookie cutter documents that they're creating by these firms who take limited responsibility for the accuracy or efficacy of their work. I am all for cutting red tape and costs for public companies, but not at the cost of timely disclosure. In specific reference to smaller companies, we do cover those who face a higher burden based on the disclosure cost levels. I would advocate for assistance. Even cost breaks could be given using better technology or proper disclosure. But I would argue, given the more fluid nature of smaller businesses, More disclosure rather than less is critical to create a clear picture of how the business is currently progressing and make informed decisions on operations. So much can change in a smaller company in 6 months. This time gap between timely exposure creates a far more ripe environment for white collar fraud, a Wild West type of environment, which could reduce capital flows long term, and the capital flows that company need would not be there. There's a reason North American markets have produced the best returns globally over the past several decades, and better and more timely disclosure is certainly a positive part of that equation. Advocating for lower cost disclosure, I can fully get behind that. Lowering the frequency of disclosure, I cannot get behind that. So that would be my soapbox on that issue right now.
Well said. Well said.
Yeah. No, I think that full disclosure is great for investors, and as we know, so much can change in 3 months for a smaller public company. And I think on the larger end, the market, like on a bank, for example, where not a ton really happens in a quarter. I mean, there can be quarterly losses, and if you're focused on that as a management team, first off, you have a poor management team if they're focused on or worried about one quarter. I know their analysts can be, oh no, this is terrible. If the management team isn't focused on the long term, regardless of whether they have to report every 3 months or not, that's on them, and they should ignore the noise around the market. They should be judged on annual and 5-year performance, really. And if the market is judging them short term, and there's shareholders are firing them, well, that's on the boards, that's on the shareholders who are looking short term. But a lack of disclosure, and I take it back to the smaller companies. We've seen companies completely change in a 6-month period. Yep. And if you didn't, and for the good and for the bad, if you had one of those scenarios where it was from the bad, proper disclosure can either get you out or at least realign your forecasts. If it's 6 months in between, it's just too far for my liking, at least.
Yeah.
Brennan's got nothing.
Well, the only thing that I would say is, and I mean, it's not even my point. I'm stealing Brett's point. Is just, Brett had said when we were speaking about this the other day, is just, probably a lot of companies would still continue to report quarterly.
It'd be good to. I would hope the good ones would.
Yes, exactly. So we'd probably still see that. But yeah, I mean, just in the chat the other day, one of our clients asked about a company that is on the Singapore exchange, and they only require semi-annual. So it is tougher to look in and analyze these businesses and have a current, up-to-date understanding on what is going on in the business.
Again, I've been watching these companies for like 25 years. It's infrequent that I hear that the thing holding companies back from being great or being a public entity is the cost. And I'm just being honest on that. It's just, if you have a great company, a great business that should be public, often the ones that I see complaining about the cost are the worst businesses out there, and they're more focused on that. If you have a great business, the money is coming in, and those are the companies that we'd like to be invested in. And I'm still all for right sizing the cost for some of the smaller companies. There's got to be some more creative ways than just saying don't report. I mean, that seems too simplistic for me. And and it's a line of thinking that, and I am not for red tape. I am for cutting out government regulation, but in areas that is needed and can prevent some heinous situations from going on. There is fraud in the markets today with the disclosures. You take away more disclosures, it is just it is a situation that would be ripe for more fraud. And that's what we should be looking to prevent. Government regulatory bodies should be looking to prevent that, and do it in a cost-effective manner. These are two things that are always weighing against each other, but just removing that is probably, it's putting wind at the back for the people that shouldn't be in this industry.
Yeah, and you probably have greater your fraud and your just general probably insider trading. Those types of scenarios occur more frequently when you do have effectively a bigger trove of information hidden behind a year away. So if something changed in January and you don't report till December, you have not you have 11 months of, your CFO talks to a friend who talks to a friend who then trades on that information well. You have all those issues, and the externalities of the fraud and stuff will probably outweigh whatever little cost savings especially for the bigger US companies.
Yeah. So do we have like 5-month blackout periods? Like management can't trade for that. Like you'd have to completely rewrite all those rules. But anyways, yeah. That's our soapbox. Let's. Is there anything further we want to get to, or should we just get to our companies, the meat of the show? Yeah.
Let's get into the meat.
All right. There's got to be a better way to say that.
Meat and potatoes.
Okay, there you go. All right. This week, I am going to review Neo Performance Materials, symbol NEO on the TSX. Trades around $16.50, $687 million market cap, pays about a 2.4% yield. The company is a global leader in the innovation and manufacture of rare earths and rare metal-based functional materials. They have 3 business segments intersecting the engineering, processing, and manufacturing of rare earth and critical mineral materials and magnets. The global leaders in each area, given their 30 plus years of operating history, and have 9 manufacturing facilities in China, Germany, Estonia, the UK, Canada, and Thailand, plus a dedicated R&D center in Singapore. I'll give a quick rare earth 101 here. Rare earths are a group of 17 metallic elements. They're most simply broken down by their atomic weights and then referred to as either light or heavy rare earths, so LRE or HRE. Rare earths are used in magnets, phosphors, metal alloys and batteries, auto catalysts, fluid cracking catalysts, glass and ceramic additives, and glass polishing powders. Many of these elements are used in a number of today's cutting-edge technologies. The stock has had a great 2025 year-to-date performance, up over 100%. But if we look long-term, the stock has been very volatile and is actually down from where initially went public around in 2028, is actually down around 6% since that time. And that is the all-time performance on the company. But what is driving the growth of the company this year? Well, revenue is up to $114.7 million from $107.5 million in the Q2 period. Operating income was up to $8.2 million from $5.8 million in the first half of the year, was about 17.8 up from 11.8. And adjusted net income was up 46%, 19 cents per share from 13 cents per share in the same quarter last year. These are management's comments on the quarter. They also raised their guidance and gave a bit of an outlook here. They said Neo delivered strong second quarter results with adjusted EBITDA up 42% year over year. Our performance for the first half of 2025 is ahead of expectations, reflects strong execution across the business. The results were driven by continued strength in our key end markets and solid operational performance across all our segments, including 31% volume growth in MagnaQuench. This is the guidance increase. Given our strong first half performance and business outlook, we're raising our full year adjusted EBITDA guidance to 64 to 68 million. So a raise in guidance there, that has helped the share price go forward. Where are the valuations today? Based on this year's expected adjusted EPS 48, so high based on that. EV to EBITDA 8.2 is more reasonable given the growth there. Expected to be a significant uptick in earnings on an adjusted basis in 2026, and that would be cutting it in half, by more than in half in terms of the adjusted PE there. And again, adjusted EV to adjusted EBITDA is 7.4 times 2026 expected EBITDA. The conclusion here, the bull case for the business, it kind of intersects multiple areas of rare earth element and related magnetic, chemical, and compound nationalization, and potentially has a decade plus of growth ahead of it. Many say there's 3-4 decades. Again, that is your absolute bull case. What we've seen from this business, we've monitored it in the past, but they've been moving up the value chain. The business has been slowly moving up that value chain in recent years, starting to reap the rewards, potentially in terms of more consistent results. We'll see if they can continue that. They're global leaders in permanent magnet manufacturing. This is a complex task and automotive emissions catalyst that have years of growth potentially ahead of them. These are the predictions, and have operationally improved historically volatile rare earth business lines to be more consistent. Historical earnings, like I said, have fluctuated significantly with price of inputs and end products. The valuations here based on current earnings are high. If the company can deliver on growth, they're more reasonable. We continue to monitor the company, and it is a company that we're looking at once again more closely.
But yeah, I mean, just generally, like you said, like the results have been quite volatile. Like looking, Q2 2021, the MagnaQuench division did, 15 million in adjusted EBITDA. All of a sudden, we're looking at Q1 2023. They did, 4 million adjusted EBITDA. It's been very volatile. But yeah, I mean, obviously the outlook is looking a little bit better right now, leading management up its guidance.
Yeah, and they've moved into more
Of the
value added
Yeah.
areas of the business that should allow them to have more balanced earnings.
Mhm.
This is what the business is trying to do and progress down that path. There's another company, MP Materials, that we've looked at. The one area, I mean, uh, Neo has separation alloys and magnets as part of their value chain now. They didn't have it; they're more just a separator at one point in the past. And they, there's a potential for Neo to get into the mining. MP has all three of those, and they actually have a mine too as well. So they're like a fully vertically integrated company in this segment. There's potential for Neo to get to that at some point, but they're certainly in more value added areas, and whether that like the plan is to smooth out earnings to be able to grow regardless of where the end prices of these rare earths are and the inputs of these rare earths, because when you're processing, you're also purchasing and then having to process that. So separation and a number of the things that this company does, but they're certainly in an area that should have significant years of growth ahead of it if they can continue to benefit from that and smooth out those earnings. Then it becomes something to be more attractive. Again, we'll probably reach out to management one more time and have that discussion and see how far they are along in that process. All right, let's move on to our next Your Stock, Our Take. Or this was a question that came in, I believe, in one of our client chat sessions. And
Correct.
Brennan, again, as always, you're going to look at some absolute garbage stocks. That's
Yeah.
what you bring forward consistently. Speaking
Yep.
of consistent in terms of earnings from Neo, consistently, Brennan, looking at some garbage companies, right?
That is correct.
It gets funnier. All right. Now you're looking at the waste management companies. It should be businesses that, we continue to have waste in this world. And, whether it be going into landfills or processed on a more environmentally friendly basis, these businesses are some of the biggest in that industry.
100%. So yeah, like you said, this was a question in our Monday chat. The client specifically wanted us to look at Waste Connections, GFL, and Secure Waste Infrastructure. So I thought that I'd do a little bit of a deep dive today. So Waste Connections, WCN on the TSX, currently trading at $240 roughly, $62 billion market cap, slight yield of 0.7%. And again, they provide non-hazardous waste collection, transfer, disposal, and resource recovery services in the US and Canada. GFL Environmental, GFL on the TSX, currently trading at a price of $63, $23 billion market cap, and a slight dividend of 0.13%. And like Waste Connections, very similar, providing non-hazardous waste management and environmental services in Canada and the US. And a Secure Waste Infrastructure, SES on the TSX, trading around $17 per share, about a $3.7 billion market cap. So it is the smallest of the three. And it's got a dividend yield of about 2.4%. And they engage in both the waste management as well as energy infrastructure businesses, primarily in Canada, as well as a little bit in the US. But just generally some comments here. As you can see, again, Waste Connections is by far the largest business, while Secure is, again, the smallest. And Secure's business is a little bit different from WCN and GFL, which are more similar, WCN and GFL. But let's get into it. So looking at their share price performance since 2023, Secure has been the dominant leader, up 175%, while GFL is up just over 60%, and Waste Connections is the laggard, up slightly over 30%, but still a respectable return. Now, looking at their footprint, Waste Connections and GFL have significant exposure to the U.S., with Waste Connections and GFL at both, 86% of Waste Connections revenue is coming from the US. About 67% of GFL's revenue is coming from the US as well. But looking at Secure, about 99% of their revenue is coming from Canada. So on this slide, if we look specifically at Secure, you can see here that it provides both waste management and energy infrastructure, with most of its revenue coming from oil purchase and resale within its energy infrastructure business, where they engage in the transportation, optimization, terminaling, and storage of crude oil. But you can also see here that despite a significant amount of revenue coming from their energy infrastructure business, the income before tax is actually lower than their waste management division altogether, despite that much higher revenue that you see here. So very low margin. Now, if we look at their results, I'll just quickly go through here. Waste Connections, they do report in US dollars here. So revenue was up 7%, which was driven by solid waste pricing, but reported volumes actually down 2.6%, as they said, or they indicated that they're shedding underperforming lower price contracts. In this year, they said that it's been an outsized year of acquisitions. They've added about $200 million in annualized revenue from acquisitions, and management has been talking about significant acquisition deal flow, expecting to close another $100 million to $200 million in acquisitions later this year or by early 2026, with potentially more to follow. And looking at earnings per share, it was up 5% to $1.12. Revenue for GFL, again, this is reported now in Canadian dollars. It was up 6%, but excluding the impact of their divestiture, it was actually up 9.5% year over year. And this was led by 5.8% from pricing and 2.5% from positive volume. So they actually had positive volume compared to Waste Connections. Now, both pricing and volume were higher than expected for the quarter and continued to trend above management's initial guidance, which is positive. And just to note, the divestiture that they made, the company sold its GFL Environmental services. I believe they still own 44% of it, though. And if we look at EPS, it was 72 cents per share in the quarter compared to a loss of $1.31 last year. But adjusting out the loss on divestiture, EPS was 6 cents per share. There was also a large FX gain in the most recent quarter too, that, if we were going like to like, we would probably adjust out. And lastly here, just on Secure, Canadian dollars they're reporting in, revenue was down 6% due to lower revenues and volumes from significantly lower oil prices. And management noted that looking specifically at its waste management segment, revenues were up 6% due primarily to the acquisition of Edmonton Metals recycling business, but were offset by lower revenues from industrial landfills due to the fire season. Of course, that was quite harsh. And EPS was up 17% to 14 cents per share. And this was primarily due to share buybacks that the company has been conducting over the past year, reducing the share count by 15%. And I'll pull up some charts on the screen after so you can actually see them buying back their shares over the last couple quarters. Looking longer term, we can see quite stable growth from GFL and Waste Connections, again, with long-term growth being primarily driven by acquisitions, while Secure's revenue has been much more volatile, obviously due to their exposure to energy prices through its energy infrastructure business. And before I move on to the guidance, let's just quickly look at the balance sheets here. Waste Connections has a trailing net debt to EBITDA multiple of 2.8 times. GFL is at about 3.8 times, and Secures is at about 2.1 times. So while Secure has the best balance sheet when it comes to its net debt to EBITDA multiple, again, it is a much more volatile business than both GFL and Waste Connections, given its energy exposure. So I would expect that the sustainable debt on their balance sheet would be just generally lower. And if we look at their share counts, Waste Connections share count has been very stable, slowly coming down. GFL's has been decent, but increasing slowly. And Secures has been coming down more recently after increasing substantially in 2021 when it issued 148 million shares for the Tervita merger. I believe I'm saying that right. Now, looking at each company's fiscal year 2025 guidance, for Waste Connections first, revenue is expected to be up 6%, while net income is expected to be up 85%, adjusted EBITDA up 7.5%, and free cash flow up 7%. GFL revenue is estimated to be down 16% year over year, but this is due to, again, the sale of their environmental services business. So we're going to see that throughout all of these numbers here, just looking year over year. It's really kind of useless looking at, but EBITDA margin is expected to be at 30% this year, which is an increase of 120 basis points from last year. So they are expecting adjusted EBITDA margin to increase this year, despite, again, adjusted EBITDA being down just because of selling off their environmental services business. And management also indicated that they believe that net leverage will be in the low 3 times at the end of this year. Like I said on the previous slide, they were at 3.8 times. So they are expecting to continue to pay down debt more aggressively, which is positive. And looking at Secure, they do not have revenue guidance, or at least I couldn't find it, but they do provide EBITDA guidance with it to be up about 7%. And discretionary free cash flow is expected to be down about 8% due to several growth plans. But they do anticipate to continue to buy back shares aggressively. Quickly looking at the valuations, Waste Connections is trading with the highest valuations, likely due to its size, but it is just a slight premium over GFL. And another reason for this is possibly the higher debt load at GFL, which is, of course, a little bit more risky. But at least they're indicating that they do want to bring it down. While looking at Secure's multiples, they're significantly lower. But again, I wouldn't expect the business to demand such large multiples, given half of its business is more on the energy infrastructure side that has exposure to the volatility of oil and gas, rather than just strictly waste management, which are, of course, Waste Connections and GFL's primary core focus. Plus, Secure is just altogether a much smaller business. So on my conclusion here, rather than saying, which stock that I would like to invest in, if I had to choose one, obviously, Secure is a different business than GFL and Waste Connections. I thought that I'd just make some general comments on these waste management stocks. So while Waste Connections and GFL are quite similar businesses, and SES is a bit of a different entity with its energy infrastructure division and its significant outperformance over the last 3 years, it does make sense as oil remains elevated. I'd also really like to see SES continue to expand into more waste management to essentially diversify away from energy. Waste management is bringing in much higher margins. So that, again, is more intriguing to me. Remember, I had a client question a little while ago on this business, and, they indicated that it looks like the business is, diversifying away from the energy infrastructure side of the business. Maybe, but I think that it's quite slow. Now, from a long-term buy and hold perspective, I think that both WCN and GFL are defensible holdings, both primarily growing through acquisition. Now, neither are, necessarily cheap, but looking 5 to 10 to 20 years out, I believe that these businesses will continue to perform well if they can continue to grow accretively and not over-lever themselves, of course, taking on too much debt. So just some trade-offs between GFL and WCN. GFL does have the most significant levered balance sheet, but is working to get it more under control. WCN pays a more attractive yield. It's still pretty low at 0.7%, but GFL has been growing the dividend at a more rapid pace. And I believe, given the lower yield, GFL's payout ratio is much lower as well. But WCN's is certainly reasonable. And lastly here, WCN does trade at a premium, likely due to its size and better balance sheet. Now, when it comes to SES, the dividend yield is more attractive at 2.4%, but again, it is a much more volatile business, and its small size and more volatility is why it trades at such a discount comparatively. Look at SES's stock. Looking back, to 2014 to 2016, we saw the stock perform significantly poorly as the price of oil came down. So again, this company is reliant on the price of energy. And going forward, I would really like to see the business continue to diversify more into the waste management side of things and away from their energy infrastructure. But all are decent businesses. Again, just the risk and the volatility with SES is probably going to be much higher. And there's the disclosure.
Yeah, Brennan, certainly some garbage companies, and that was basically a waste of time. So.
Yeah, right.
I'm kidding. No, it was good. Good summary of those businesses. I think Canadians need to look at those companies, and if anybody wants a broad overview, they can reference back to that as a good overview. And like you said, long term.
Yeah, exactly. And
some
that's
value
the thing.
there. Secure is a little different from the other.
For sure, it's a little different, and our client did ask us to kind of comparing the all three, and definitely different business. I probably could have just had like waste management that I was comparing in here, rather than Secure, just to that's another obviously big name. So if there is like another garbage company or waste management company that somebody wants me to review and maybe like just stack up against Waste Connections and GFL. I've already done the work on Waste Connections and GFL, so it'd be easy for me to do. So comment that down below.
Yeah, put a bunch of garbage
YouTube
companies below and Brennan can review all of them.
Yes,
all right,
yes.
It's getting fun here. Okay, so we can move on unless, Brett, you want to no more garbage.
No more garbage.
Throw that trash out.
Yes, it's true. All right, Dye Durham. Well, speaking, not necessarily garbage, but I mean, like, here's a company that, it's a tale of like how to capitalize a business and how to kill a business, basically by taking on too much debt, trying to acquire too fast, and I'm not saying the business is dead, but this, there's certainly a leverage situation here that has to be addressed at some point.
So you're saying it's going to go die?
It's not going Durham. I don't know.
This episode is punny.
Yes.
Yeah, there we go.
Very punny.
So yes, can go into Dye Durham, symbol DND on the TSX. It is a provider of practice management software, data solutions, and payment technology to law firms and businesses. The company has 60,000 clients across Canada and in international markets, and is based in Toronto. The stock currently trades at about $8.81. That's a $593 million market cap. But the stock is down 18% over the past week after announcement of delayed filings, which we'll get into in a moment. And it is as well, it's down 38.6% over the past year, and it's even further down if you go back to its IPO and its post-IPO boom in 2020 and 2021. But the big drop this week was due to the management's expectations of delayed annual filings. The year end being June 30th, the reason for the delay is the company received a letter from the Ontario Securities Commission with concerns relating to the company testing for goodwill impairment in certain purchase accounting disclosures for the 2024, so last year's annual statements. Effectively, the company may have been overstating the goodwill value and the overall value of past acquisitions going forward. So the expectations of those acquisitions going forward. The impact would not impact cash, or the changes would not impact cash or adjusted EBITDA, as goodwill and any impairments with goodwill are IFRS figures. So you'll see those commonly adjusted out of adjusted EBITDA and so on. If they do occur, they may not occur, but you'd see them in the IFRS or the GAAP in the US financial statements if those ever do occur. This has been followed after repeated public fights with the former CEO who was removed following a proxy battle, with one of the complaints being poor governance as well as performance. So having delayed annual earnings is a further proliferation of governance and performance issues and raises the questions, can you really trust these past financials? What is going to be the overall change? Goodwill isn't the be-all of end-all of financial change, but it does increase that risk, because if that is wrong or overstated, what else could be wrong type of scenario. Looking at the Q3 earnings, so these are ending March 31st. They do have that offset year. Revenue was up only 1% to 108 million, and organic revenue actually contracted 2%, which has been really the crux of the business. It just hasn't had that organic growth, which you would want to see following these significant acquisitions they made 4 or 5 years ago. 36% of revenue was recurring and 61% of it is contracted, which is good to see. It has been able to expand inorganically since the 2020 IPO, but just the organic hasn't been there. Adjusted EBITDA came in at 55 million with a 51% margin. And as you can see, just on a longer term basis, revenue, it has fluctuated, but it's been relatively flat over the past couple of years. And similarly with EBITDA, and the last quarter was actually a bit worse on the EBITDA side. The company still has a net loss, which it was relatively flat year over year, but the net loss was 21.8 million or 33 cents on a diluted share basis. And the big difference is between the adjusted EBITDA and the net income is you have these significant finance costs as well as amortization, depreciation, which are all to do with these acquisitions. So it really inflates that EBITDA line in comparison to the net income or net loss line. So since it does have this debt-filled balance sheet and these high interest payments, let's really look into that. So given the acquisition spree post-IPO, the company has significant debt. The company has net debt, including leases, of 1.45 billion, which is comprised of, they have 2029 notes, a variable term loan, a revolver, and debentures. So a nice array of debt instruments. This results in a net debt EBITDA of 5.6 times, which is significant leverage for a company with really, at this time, no material growth, no organic growth at all over the past year on a quarterly basis. As well, I will highlight, you can see there, they have a 1.1 billion. That's about 2 times their market cap in goodwill. So you could see a big impairment on that line item. And if you do see that, you'd see a big net loss. Whether that actually needs to be reflected in the stock price, it is one of those accounting fill numbers on an acquisition. But it normally does have the perception of decreased value in the long term, and that's why you have that impairment. So it's not the actual value change, it's the perception and the expectations changing, resulting in the impairment, not the actual value being the important fact of an impairment for goodwill. The current management does have some long-term targets laid out: high single-digit organic revenue growth, adjusted EBITDA margin of 50 to 55%, which is currently incurring with their 51% in the last quarter, CapEx of 5 to 7% of revenue, and adjusted EBITDA to cash conversion of 85% or higher, which is well below at this current time, with only 64% over the past 12 months. The goal is to have significant debt repayment to get below that 3 times net debt to EBITDA, which will be a big improvement compared to where they are now. Some near-term targets include a 40 million in reduction of acquisition and restructuring costs, and a reduction of 5 to 10 million in interest payments. While any turnaround, in my opinion, is still unlikely given the current financial position, if management can trend towards debt reduction, it will increase the likelihood and likely result in positive stock returns. But on the other hand, it may never occur, and even if it does, it may take many, many years, and you could just be sitting in effectively dead capital for multiple years while a turnaround takes place. That is always the risk with turnarounds, and that could occur here. Obviously, for shareholders, you do want to go to the upside, but I wouldn't always count on a proper turnaround, because more often than not, turnarounds do fail. Moving to the valuation, the company is trading at a trailing EV to EBITDA of 8 times, which for a no-growth company is actually still quite expensive. But even more so given the debt burden and no real growth at all on the high debt levels, you do need to have some sort of growth. It's not a drastic outsized multiple by any means, but this is also after it dropping 18% in the past week. So it's not absurdly cheap by any means. When you do sometimes see these really turnaround case scenarios, if it is the dire straits, they can get very cheap. They can be 1 times trailing EBITDA, 2 times trailing EBITDA, 8 is still actually a decent valuation for a turnaround story. So to summarize, the company has had significant governance and performance issues, with the latest issue now raising issues over past financial statements, specifically around goodwill and acquisition disclosures. The debt level is just simply too high and needs to be reduced, as it's not sustainable in any sense with the current prospects. We would want to see progression towards the desired organic growth level on top of that debt reduction. And even in its current state, shares are just not overly cheap. Since I have been so negative as well, I will point out there has been a general progression to recurring contract-driven revenue, which is a positive, and that is really the great thing to see for these software companies and service solutions is this contract and recurring revenue, because that does produce some sort of cadence of reliability. If they didn't have this, if you were seeing revenue go up and down, that does make debt positions harder to manage, which is something which can aid them in a turnaround or a proper turnaround. But for now, we will continue to monitor the stock, and for disclosure, we have no position in it.
Yeah, good summary. DND just overpaid for assets. It took on way too much debt for a business with limited to no organic growth to pay for those acquisitions, and now it's paying too much interest and destroying profitability. Everything was sexy. We were getting tons of questions about this business when it was making an acquisition announcement on a monthly basis, but that kind of drunken acquisition spree has produced what we call a debt hangover that would take a long-term cure. The founder or the original CEO of the company has no patience for that. It's not surprising, as he was the one behind the strategy to get to this point, right? But the business may be sold, as there is a business here. When you get if you got rid of all the debt, it would be interesting. But you'd like to see more organic growth. It would have to be trading at lower multiples. But I don't know who would want to take on that debt. The equity may have to be cut. I'm not saying to zero, but the valuations at present, like Brett said, are still not great. You have to mind your capital structure, and whether it's debt or continuing to issue shares, eventually you pay the piper for that. And in this situation, it's in a bit of a spiral here in terms of like that massive debt burden and trying to somehow grow organically, which it's not really, and to produce some kind of profit. It's just bleeding right now. Yeah, I mean, we just see other businesses with better growth without that hideous balance sheet.
Exactly. Someone set up great.
Yeah. All right, Brennan, you got nothing else? You're done? You fell asleep a while ago or what?
Tired of trash stocks.
Mm-hmm. You're muted too. Your comments are trash, I'm sure. Anyway, so
I'm tired of trash stocks. No, Brett was
Yeah.
right. I'm tired of trash stocks. We need to bring some good ones next week.
Excellent. Really funny. Okay, so all right, that's going to end our show for this week. If you are watching this on YouTube, smash that subscribe button. If you're viewing or listening to this wherever you consume your podcast, rate and review us. Keep your questions coming in to our Yours Talk, Our Take segments. If you want to look at our last webinars, go to www.keystocks.com. You can get those on demand, I believe. And as always, I wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.